There is one key incentive that is still there, and that is enhanced capital allowances. What enhanced capital allowances allows a company to do is that the company can take an additional tax deduction for their expenditure in property, plant and equipment, provided they meet a minimum investment of $3 million. Now, this benefit is there for existing companies as well as expansions by new companies.
The VAT framework in Sri Lanka has indeed undergone several changes over the years, aimed at making it more business friendly. While improvements have been made, complexities still exist. This poses challenges to the businesses. From a policy standpoint, changes to the revenue administration process through the RAMIS system is to modernize the revenue administration system. The goal is to streamline the VAT compliance, online submissions of returns, filing of schedules, and credit reconciliation.
Another strategy that is available to exporters to the US specifically is the first sale to export concept. It's an incentive scheme provided by the US government where you are able to exclude that part of the value chain attributable to functions carried out by a trading house. So we as EY have helped quite a few in getting this concession where you route your exports through a trading house and thereby minimize or reduce or manage your customs duty exposure to the product value.
So if you look at the tax policy in the last 2 to 3 years, it has been to end all tax holidays, to remove the exemptions, and to do away with all the tax deductions that were there for expenses like R&D. Now, whilst most of these tax exemptions were removed, there is one key incentive that is still there, and that is enhanced capital allowances. What enhanced capital allowances allows a company to do is that the company can take an additional tax deduction for their expenditure in property, plant and equipment, provided they meet a minimum investment of $3 million. Now, this benefit is there for existing companies as well as expansions by new companies. So, if you look at the corporate strategy, a lot of companies are strategizing to avail this tax incentive. So, we see a lot of companies relooking at the expansion plans, capital expenditure plans, not just for the next 1 to 3 years, but they're looking a bit beyond that to see if anything can be advanced. Because to qualify for this incentive, you need a minimum of $3 million. And also companies are relooking at their dividend payout policy to see whether it's more beneficial to retain funds within the company to help with this incentive. So that's one key policy change that has impacted strategies that we see. Other is in relation to tax risk management. The tax authorities are very aggressive when it comes to revenue collection. We see a lot of assessments being raised, a lot of IRD audits taking place, and also the tax authorities are resorting to aggressive revenue collection methods like seizing bank accounts. So, in this backdrop, we see a lot of emphasis being placed on tax risk management. For example, companies are doing a lot of health checks. They are doing a lot of periodic reviews to see whether they are compliant with the tax laws. Then also, companies are relooking at their procedures, protocols in relation to tax compliance, and also in relation to IRD correspondences to make sure that all the assessments are appealed and all the IRD correspondences are properly addressed. So this is part of the tax risk management. Also, there is interest charge. If a company fails to pay the tax that's due, interest is charged every month. Now, although it's every month, it actually adds up to quite a significant amount because assessments are raised about 24 months down the line. So that comes to about 48% of the tax that's assessed. So because of this interest, now companies are focusing more, they're relooking rather at certain tax positions that they have taken, and also they're adopting more sustainable tax positions. So one key sector that's affected with the tax changes and the removal of exemptions and concessions is the SME sector. The SME sector earlier enjoyed a concessionary tax rate of 14%. And also when it comes to VAT, earlier the VAT threshold was quite high. But that was reduced to 60 million per annum. So with all these changes, the SME sector is vastly impacted. Now, the SME sector is the backbone of the country. You need the SME sector to generate employment, to foster innovation. It's crucial. So given this backdrop, and the government does recognize the importance of the SME sector. If you look at the budget for last year, about 20 billion was allocated for the SME sector. But still, I feel that you need to incentivize the sector through tax concessions also. If you look at the region, for example, India, a lot of tax incentives are given for the SME sector. There is a tax rebate that is given to the SME sector, where deduction is given for the tax profit against your future tax profits. Such incentives are important for the SME sector. And because of this high threshold, some of the companies find it difficult to match up to this amount. So what can be done is that the SME sector can be given, or rather a lower threshold can be introduced in terms of incentivizing the SME sector. Another incentive that could be given to the SME sector is actually by way of enhanced capital allowances, because right now enhanced capital allowances are given for big projects which requires a minimum of about 1 million rupees to qualify for the incentive. So if enhanced capital allowances can be given for projects which require a less capital expenditure, certainly below 1 billion rupees, that would really help incentivize the SME sector.
That framework in Sri Lanka has indeed undergone several changes over the years, aimed at making it more business friendly. However, while improvements have been made, complexities still exist. This poses challenges to the businesses. From a policy standpoint, changes to the revenue administration process through the RAMIS system is to modernize the revenue administration system. The goal is to streamline the VAT compliance, online submissions of returns, filing of schedules, and credit reconciliation. The direction is in the right direction. However, when we speak to businesses, they claim that the complexities still exist. They find it difficult. Issues such as mismatches. For instance, if you claim a 1 million rupee input claim, and if there is a small minor discrepancy from the declaration of either parties, whether the supplier, even a cents, entire input is denied in the system. This causes an additional assessment being issued, and the businesses will have to face challenges in resolving them in the system. A significant recent change is the removal of SVAT, Simplified VAT Scheme, which was in operation for 14 years, which was introduced to mitigate the risk and challenges faced in the cash refund system that prevailed previously. Exporters under the SVAT scheme, they do not need to pay VAT in cash. Instead, they can settle the VAT through a credit note issued by the tax department. So this avoided a need for a cash refund. However, with the removal of SVAT, the exporters may have to go back to their cash refund system, which may cause them longer time to receive the refunds, which can cause a cash flow difficulties to the businesses. The tax authorities have promised the refunds will be processed within 45 days under a risk-based refunds scheme. The required regulations are yet to be released. However, based on the information available, we understand the entities will be categorized into 3 risk categories: high risk, medium, and low risk entities. Based on the risk categorization, the refunds will be processed. So, if you are categorized a higher risk entity, your refunds may be delayed more than 45 days. So, in order to receive your refunds within the timelines, it is important and vital to ensure that your compliance status in the tax department is updated and reflects the correct status, and thereby you can mitigate any delays in getting the refunds. There are differences, particularly the recent change of mandatory online filing may cause challenges to SMEs because they might not have the required human and the financial resources to accommodate the change. So that is one aspect from a mandatory change. With the change of a mandatory VAT registration, if you have any exports or imports, the businesses is required to register mandatorily, which causes their supplies to be charged for VAT irrespective of their turnover threshold. So that causes a challenge for SMEs, especially compared to competitors. Those who are below threshold may not charge VAT, but you may have to charge VAT because you have just exported a few exports. You have just started an export, or you have imported any items for your business. Simply because you are imported or exported any articles, you are mandatorily required to register for VAT. This causes all of your supplies to be charged for VAT. So that is a challenge that SMEs may face with the recent change. In addition, the SMEs may face challenges with the removal of SVAT. This can cause cash flow problems for SMEs because of the delays in getting the cash refund.
Yeah, so I think the first step what they need to look at is the markets that they are in, right? So if you're heavily exposed to the US market at the moment, what you should do is look at your product portfolio and see what other markets that this can be actually exported to, and not limit yourself only to the US. So if you're currently heavily exposed to the US, I think the first step is to go into a lot of detail into other markets, and that investment, I think, proves very significant given the current volatility that we have seen in the tariff. And it becomes a business continuity issue by not actually carrying out that exercise. So whilst carrying out that exercise of looking at other markets and even diversifying product is also, I think, important to engage your US counterpart. And I know a lot of businesses, exporters have already started that, where they look at how this cost, if it is a reality, how it's going to be spread across the value chain. And those negotiations have brought in fruition, and I think that negotiation is taking place and has come to an end, subject to, of course, how these tariffs will pan out in the longer term. Another strategy that is available to exporters to the US specifically is the first sale for export concept. It's an incentive scheme provided by the US government, where you are able to exclude that part of the value chain attributable to functions carried out by a trading house, right? So we as EY have helped quite a few in getting this concession, where you route your exports through a trading house and thereby minimize or reduce or manage your customs duty exposure to the product value. So being in so many countries, we have taken on this tariff issue as a firm. We are in more than 100 countries in the world, and we understand the tariffs of each country and also the rules of origin of each country, where we're able to bring in solutions in relation to how best to structure or restructure your trade, not only the short term, but I think looking at the medium and long term as well. So the industry should also, I think, continue to proactively engage the government in ensuring that these tariffs are really negotiated to the country's benefit, where we have a robust agreement with the US in the long term. And we need to also look at all other trading partners wherever FTAs are possible. We need to go for them, especially with our largest trading partners, the US, EU, maybe China, and India. You said trade, I think from a Sri Lankan context, it is very much linked to exports and export-related growth. So we saw in this time's budget as well, they were talking about economic growth based on exponential growth in exports is what the government is expecting. So in order to do that, I think we need to first identify what areas of exports we want to get into. As a policy, we need to develop a policy. In this policy, we can't go after every type of product because we have certain strategic advantages within Sri Lanka that has to be studied in detail. And we need to identify for ourselves what are the top 4 or 5 products that we want to grow. So if you're going to grow exports, either you have to invite new investors to come and start exporting, or encouraging the existing exporters to expand their products, or non-exporters to get into export. So to do that, this policy will be critical, and we need to incentivize in terms of doing business indicators, in terms of approval speed, in terms of having land available, plug and play zones available for those investors to come in and take on this export growth objective that we have. So in doing this, it is critical that we give a value proposition to those investors with clear cut timelines. For example, all of the regulators like the BY, ROC, all of the regulators from environment clearance need to have a clear timeline within which these projects will be passed. And an exporter knows maybe, let's say, in 6 weeks, I'm going to be able to start work on my project. So it's, for example, like the 24-hour passport we had those days. When we knew we paid the fees, we definitely got it. But that kind of value proposition has to come from these agencies, and they all have to work in one unison as one agency to make sure that we give this confidence to the market, drive investments in exports. So with export growth comes imports as well, because they go hand in hand when you talk about trade policy. And one of the key issues we have, and that is brought up in the budget as well, where the government has promised us a new customs law to replace the existing one, hopefully this year, which will modernize the entire operation of the customs, including their practices, and move into digitalization as well, because the existing staff in the customs cannot accommodate the number of imports we are having to do checks on them, to do analytical reviews of what to pick for an audit or detailed raid. So it is critical that these new initiatives come into play. New digitalization is brought in where the documentation is also digitalized. Scanning is also done in an automated way in order to ensure that the other leg of export promotion, which is imports, is equally streamlined and caters to our export growth strategy.